March 9th, 2009. The S&P 500 is sitting at 666. The world is convinced it's going to zero. Two guys, same age, same job, same salary, same $5,000 scraped together. Guy number one looks at the headlines, looks at his portfolio going red, looks at CNBC running the word crisis in giant letters, and moves everything to cash. Guy number two grits his teeth, keeps investing $500 a month, doubles down when things get worse. By 2020, 11 years later, guy number one has roughly $18,000. Guy number two has over $210,000. Same starting point, one decision, $192,000 apart.
Right now, in April 2026, you are standing in that exact same moment. And most people are about to make the exact same mistake guy number one made. I'm Ape. Welcome. By the end of this video, you'll understand three things. Why this moment looks terrifying, but the data says something completely different. Why the people who feel safest right now are actually taking the biggest risk, and exactly what to do with real numbers, not opinions.
This is not financial advice. This is 100 years of math. Let's go.
Here's the situation as of right now. February 28, 2026. The U.S. and Israel launch military operations against Iran. The Strait of Hormuz, a 21-mile waterway carrying 20% of the world's daily oil supply, effectively shut down. We already did a full video on that. Go watch it after this one. Here's what that did to markets. Oil was at $72 a barrel before the war. By end of March, Brent crude hit $118. That's a 63% spike in a single month, the biggest monthly move since 1988. The market did what it always does with uncertainty. It freaked out. S&P 500's worst quarter since 2022, down 4.6%. The Nasdaq dropped over 10% from its highs. Microsoft down more than 20% year-to-date. Tesla over 21%. The VIX, Wall Street's fear gauge, nearly doubled, spiked from the mid-teens to over 35. The CNN Fear and Greed Index is sitting at 8 to 17, extreme fear. Readings that low have appeared on just 3.4% of all trading days since 2011. 3.4%. You are living inside a statistical anomaly. And the financial media's advice? Panic. Watch the next segment. Maybe buy gold. Watch another segment about whether you should have bought more gold. Here's what 100 years of actual data says instead. Before we get to the data, let's actually understand the fear, because understanding it is how you stop being controlled by it. Here's the fear chain right now. Oil spikes. Higher energy costs push up inflation across everything: manufacturing, shipping, food. If inflation rises, the Fed can't cut rates like it planned. If it gets bad enough, they raise rates. Higher rates slow growth. Slowing growth plus rising inflation equals stagflation, the financial nightmare of the 1970s that took a decade to unwind. I'm not going to tell you that can't happen, but comparing 2026 to 1973 is like diagnosing someone with the flu because they also have a headache. Yes, there's an overlapping symptom. The conditions underneath are completely different. In 1974, inflation was running at 10.1%, climbing toward 14.5%. Unemployment hit 9%. GDP was contracting. The U.S. was almost entirely dependent on foreign oil. Today, inflation is around 2.7%. Unemployment is 4.2%. GDP is still positive. The U.S. is now one of the world's largest oil producers. The structural conditions that made the 70s a decade-long disaster simply don't exist.
Economists who've modeled this put stagflation probability at 20 to 40%. Elevated, yes. Base case, no. And here's the thing about markets. They've already priced in the worst case, which means if the worst case doesn't fully materialize, and historically it rarely does, there's only one direction prices move from here.
Put your gut feelings to the side. When you have a gut feeling about the stock market, go outside. That's where gut feelings belong. Let's talk about data. RBC Wealth Management analyzed 20 major military conflicts since World War II: Korea, Vietnam, the Gulf War, Iraq, Russia, and Ukraine. Across all of them, the average S&P 500 decline was 6%. The market bottomed in an average of 28 trading days and fully recovered in an average of 39 days. 39 days. That's about 8 weeks. While you were waiting for certainty, watching the news, feeling sick about your portfolio, refreshing your brokerage app, the recovery had already happened. The people who stayed invested captured it. The people who moved to cash captured none of it. When Iraq invaded Kuwait in 1990, oil spiked, markets fell. Sound familiar? The S&P dropped 15.9%, then gained significantly in the year following the war's end. When the Iraq War launched in 2003, the Dow actually rose 2.3% the day of the invasion. Russia invaded Ukraine in February 2022. Markets reacted with volatility. The S&P fell roughly 7 to 8%. Since that war began, the S&P 500 has risen more than 60%. Wars feel catastrophic. Economically, they historically haven't been. The American economy is large enough to absorb almost anything that doesn't directly halt its functioning. Nothing happening right now comes close.
Let's zoom out further. Average bull market over the past 100 years, 4.9 years, 177% return. Average bear market, 1.5 years, 35% decline. Positive returns over rolling 10-year periods, 94.1% of the time. Over rolling 20-year periods, 100%. Every single one in recorded history, including the ones with world wars, depressions, oil embargoes, financial crises. 0 exceptions. None. I know that sounds like something a guy would say in an infomercial at 2 in the morning. I'd be skeptical too. But this isn't a prediction. It's the complete historical ledger. And the feared lost decade, 2000 to 2010, where the S&P went essentially nowhere? That's happened twice in a century. The probability of it recurring from today's conditions is roughly 5%. And even in that scenario, if you kept investing through both crashes and held 20 years, your total return was 350%. You still quadrupled your money, just slower than you wanted.
Let's go back to where we started. March 2009, guy number 1 and guy number 2. The market had collapsed 57%. The news was wall-to-wall disaster. Unemployment was climbing toward 10%. Guy number 1 looked at all of that and said, "This feels completely insane," and moved everything to cash. Here's the thing, he wasn't stupid, he was human. Every headline supported protecting yourself. Every conversation with friends supported it. His nervous system was screaming that moving to cash was the rational, responsible move. It genuinely felt like the right call. Guy number 2 gritted his teeth, kept investing $500 a month, doubled down when things got worse. The market bottomed on March 9, 2009. By June, just 3 months later, the S&P had already recovered 40% from the low. Guy number 1 eventually got back in, but he got back in at higher prices, after missing the recovery days. By 2020, guy number 1 had roughly $18,000. Guy number 2 had over $210,000. Same starting point, same income, same knowledge. One decision. $192,000 apart. The gap between them wasn't intelligence, it wasn't information, it wasn't luck. It was the ability to look at what the data said and act on it, even when every headline was pointing the other direction.
Here's the part that trips people up every single time. Selling during extreme fear feels like the safe move. It is not the safe move. Here's why. The biggest single-day gains in market history occurred during bear markets, not during bull markets, during bear markets. If you missed just the 10 best trading days of the S&P 500 over the last 30 years, your total return drops from roughly 1,000% to about 380%. 10 days out of roughly 7,500 trading days. And you never know when those 10 days are coming. They don't announce themselves. They show up in the middle of the panic, when your portfolio is red, when the news is screaming, when everything feels like it's getting worse. The feeling of certainty that you're waiting for, that it's safe now signal, always arrives after the recovery has already started. By the time things feel safe enough to buy, the best prices are gone. That's exactly what happened in 2009. It's what happened in March 2020 with COVID. The window lasted weeks. Right now, the CNN Fear and Greed Index is in the bottom 3.4% of all historical readings. Conditions this extreme have historically been closer to the end of a fear cycle than the beginning.
Okay, here's where we actually get practical. Right now, you have exactly 3 options. Let's run all 3 honestly. Option 1, sell, move to cash, wait for it to feel safer. This sounds like caution. It is not caution. Waiting for safer is code for buying back in at higher prices after missing the recovery days. Dalbar, a financial research firm, has tracked the average investor's actual returns for decades. The average investor consistently underperforms the index by roughly 3 to 4 percentage points annually. The gap isn't fees, it isn't bad stock picks, it's moving to cash during fear and missing the recovery. Selling during extreme fear is the most expensive financial decision most people ever make, and almost nobody realizes they're making it in real time. Option 2, do nothing. Hold what you have, don't add, don't sell. Better, you won't lock in losses, you won't miss the recovery, but you won't capture the compounding advantage of buying at discounted prices either. Holding is the floor, not the ceiling. Option 3, keep investing. Stay on your regular schedule at minimum. Your emergency fund stays your emergency fund. You don't invest money you'll need in the next 12 months. But the money you were planning to invest anyway, you're getting it at a discount that didn't exist 6 months ago. When the market drops 30%, your monthly investment buys 43% more shares than before. A 40% drop gives you 67% more shares per dollar. You're not losing ground during those months. You're accumulating ownership of great businesses at a discount. The only scenario where this logic breaks is if the U.S. economy permanently collapses and the S&P goes to zero. And if that happens, your stock portfolio is genuinely the least of your problems.
Let's talk about what smart money actually does right now. Not tips, not hot stocks, structure. Step 1, emergency fund first, always. If you don't have 3 to 6 months of expenses in cash, this is not your moment to go heavy on equities. Build the buffer first. Research from Vanguard found that having just $2,000 in emergency savings increased financial well-being scores by 21%. That was the largest boost linked to any single financial factor they measured. $2,000, not $1 million, $2,000. The emergency fund isn't just money, it's the thing that prevents you from selling your investments at the worst possible moment because your car broke down. Step 2. High-interest debt kills everything.
If you're carrying credit card debt at 22% and investing at the same time, you have a bucket with a massive hole in the bottom and you're wondering why it won't fill up. Paying off 22% debt is a guaranteed 22% return. Warren Buffett's long-term average is around 20%. You're already beating him by paying off your credit card. Kill the high-interest debt, then invest. Step 3. If your employer matches, take the full match before anything else. This is a 100% guaranteed return immediately. Even if you're carrying some debt, an immediate 100% return on employer match almost always wins the math. Don't leave free money on the table. Step 4. Index funds, not individual stocks, not crypto speculation. Right now, the S&P 500 is sitting roughly 8 to 10% below its all-time highs. You are buying at a fear discount on something with a 100% positive return record over every 20-year period in recorded history. Not one financial manager has consistently beaten the index over 20 years, not one. You don't need to pick winners, you need to own the whole market and let time do the work. Step 5. Keep investing every month, automatically, like a bill. The $500 a month investor from 2009 didn't get rich because they were brilliant. They got rich because they kept going when everyone else stopped. Consistent monthly investing through a market down 5% earns roughly 66% over a typical cycle. Doubling contributions when markets drop more than 5% earns roughly 84%. The panic sellers got whatever their savings account was paying, which during that period was essentially nothing. APE is not judging, APE is just doing math.
If you're new here, APE explains the financial stuff that actually affects your life that nobody broke down properly. Hit subscribe. We'll be here.
One more thing that consistently gets underplayed. When the rest of the world gets unstable, money doesn't scatter randomly. It goes somewhere specific. The United States, every time. Over 60% of global foreign exchange reserves are held in US dollars. The Treasury market is $24 trillion, the deepest, most liquid financial market on Earth. When things go sideways globally, institutional money from every corner of the world flows into dollar-denominated assets. Not because anyone loves the dollar, because there's nowhere else large enough to absorb it. During March 2026, the US dollar index surged 2.6%, its best month since July. During COVID, it spiked 9%. During Russia's Ukraine invasion, nearly 12%. Global chaos and US market performance are not the same thing. Historically, they can actually move in opposite directions. The world panics, capital floods into US assets, prices go up. There is a certain mathematical poetry to that. APE did not design the system. APE is just explaining it.
Here's everything in 60 seconds. The Iran war triggered a 63% oil spike and market fear in the bottom 3.4% of all historical readings. Extreme fear is not the beginning of collapse. Historically, it's been closer to the end of one. RBC Wealth Management studied 20 major military conflicts since World War II. Average S&P decline, 6%. Average recovery, 39 days. The S&P 500 has positive returns over 100% of rolling 20-year periods in recorded history. The safe move of selling during panic historically produces the worst long-term outcomes. Missing just 10 trading days over 30 years drops your returns by more than half. Emergency fund first, high-interest debt second, index funds third, monthly and automatic always. The people who stayed invested in March 2009 had $210,000 by 2020. The people who moved to cash had $18,000. The gap wasn't intelligence, it wasn't information, it wasn't timing. It was the ability to look at what the data said and act on it when their gut was screaming otherwise.
Here's what nobody says out loud about moments like this. Staying invested right now doesn't feel brave. It feels reckless. Every headline is designed to make it feel reckless. The news has a structural incentive to keep you scared. Scared people watch more news. More news means more ads. More ads means more revenue. Your fear is their product. The financial industry has a different structural incentive. They make money when you trade. When you sell in fear and buy back in later, you've generated 2 commissions and captured none of the recovery. Your anxiety is their revenue. The data doesn't care about any of that. The data says markets process geopolitical shocks in weeks, not years. The structural conditions for a multi-year collapse are largely absent. Private sector balance sheets are healthy. No hidden leverage bomb. No subprime time bomb. The fear is real. The structural conditions for a permanent collapse are not. Those are very different things. Guy number 1 wasn't stupid. He was human. He let his nervous system make a financial decision that his logic should have made instead. You don't have to be that person. You just have to understand the math clearly enough to act on it when your gut is screaming otherwise. The window is open. What you do with it is yours.
If this video changed how you're thinking about the next few months, drop a comment below. Seriously, tell me what you're doing. Are you staying in? Are you adding? Are you panicking? Ape is not here to judge. Ape is here to look at the math together. Hit subscribe if you want Ape to keep explaining the stuff that actually affects your money that nobody broke down properly. Guy number 1 watched the news and moved to cash. Guy number 2 subscribed to channels that explain the math. Correlation noted. See you next time.